All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for another monthly Macro Maven marvelous update from the Macro Maven herself, Stephanie Pomboy. Hey, Steph, how you doing?
I'm great, Adam. How are you?
Good. Happy New Year. Hope you had a wonderful holiday.
I sure did, although it seems like forever ago at this point. The first 2 weeks of the year feel like, a decade already. So
I know. Well, we titled this Get Ready for a Wild Ride in 2026. If the first 2 weeks of the year are any example of that, I think we're spot on there.
yeah,
Did Wilhelmina did Santa leave some good snacks for her under the tree this
I
year?
mean, every day is Christmas for her, as I'm sure
Right, yeah.
the same for Boston and Bodega. They probably are equally spoiled, I have to imagine.
They had a good time. We kind of spoiled them more with hikes and whatnot. They have loved it. Their labs, it's a breed that was bred in the cold, Newfoundland north, but they'd never seen snow before, and
Oh,
it has
wow.
like unlocked something in them. They just can't get enough of it. They love it. So,
Frisky.
anyways, yeah,
That's awesome.
they're
Good.
doing well. Speaking of Wilhelmina, though, I think I hear her gently
Yeah,
snoring there in the background.
the soothing sounds of Bulldog.
Yes. Well, I'm glad she joined us here today. All right. Well, look, there's an awful lot to talk about. I also polled our audiences on X to see if they had questions. I got a ton. So I'm going to ask my questions. I'm going to ask some of theirs. If there's time left over, we'll open it up to folks watching here in the live chat. But most important topic to start with, Steph, is that your and Grant Williams's Super Happy Terrific Day conference is just a month away.
It's fast approaching. I know. I can't believe it. It feels like when we started planning this, that it was like forever down the road. And then I blink and all of a sudden it's here. And I'm so excited. I know I mentioned this last time that you're going to join us for that, because I think that just adds such a fun element to the whole proceedings. So super excited to have you. And we've got a great lineup, including people that you often have here on your program. So it'll be a great opportunity to mix it up with people like yourself and Grant and me and the people at Copernic, as well as Tom McClellan and Tom Hennig.
Mike Green too.
Yeah. So yeah, it's going to be it's an interesting and diverse cast of characters. And like you said, given how this year has started, the timing could be
better.
Fortuitous.
Yeah, it could definitely not be more timely. All right, so for folks that would like to attend or at least learn about the event, where should they go?
Yeah, well, I will post this on my Twitter. I have posted it, and I'll pin it on my Twitter feed at spomboy, a link to register, or you could go to macromavens.com and inquire there. But let me post it. It's probably best for me to just post it on the Twitter. And there's a registration link, and it is immediately after President's Weekend. So it's February, February 17th and 18th in sunny South Florida in St. Petersburg, which is just a really cute town. And it's a beautiful hotel that we do the venue at, an old historic hotel. So great opportunity to get out of the cold weather for a little bit.
Yeah, I can't wait to go for the fun and the people, but also, to get out of the cold that we're having here and go spend some time there. So folks, if you want to join us for Fun in the Sun with Steph and Grant and the A-listers that they've assembled for this event, please come join us. All right, Steph, well, look, the topic that is on everybody's mind this morning, especially in regards to you, who's been such a champion for the precious metals, is...
now what?
Now I mean, we're in a clear melt up, at least for silver, for sure. But both gold and silver, as of this morning, hit all-time highs yet again. Silver futures were at one point at least above $92 an ounce. I can't believe those words are leaving my mouth.
Yep.
The Shanghai price is $10 or more above that. Wow. So it's already triple-digit silver in dollar terms over in China. So I guess my main question to you is just, what's your response to what's going on right now? And then I've got a whole bunch of follow-up questions like, okay, so when do you start determining when it's time to sell and da 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 da?
Yeah, no, I saw the response to your Twitter question to people, and there were a lot of questions about when to get out, and so that's definitely a timely and interesting topic. And I will confess that I think, like you, the move has unfolded much more rapidly than I expected. I mean, I did expect, and I still expect, to see gold, north of $6,000, in the not so distant future. But the speed with which we've gotten there has taken me by surprise.
So sorry to interject, but I was trying to explain this to my wife the other night. I'm like, she knows that we bought precious metals a long, long time ago. And I'm like, they've done exactly what I thought they were going to do price-wise. In terms of getting to the prices that I bought them because I thought they were going to get to, they just decided to wait a whole bunch of years to do nothing, right. and then make it all up in a year.
Yeah. Oh my God. Yeah. It really has been an emotional roller coaster because for that long stretch of time, we were basically like, oh my God, is this ever, all of the pieces were falling into place, but the metals weren't really responding, and especially not the miners. That was the thing you started to see, like in gold, for example, the prices move up and the miners were just dead money. And then all of a sudden the catch up has been spectacular and a little unnerving, frankly, because of the speed with which it's happened. And I do joke sometimes with people, like, maybe part of the reason why we find it unnerving is just that we've been so bruised and bloodied after sitting hunkered in the trenches for so long, that this just feels like an out-of-body experience. And, you never think of the metals or the miners as meme stock equivalents. You don't never imagine yourself in that kind of feeling like, oh my God, this is just a massive move and I'm making, all kinds of money in these crazy things. And here we are. And it's scary because it does have those similarities to what we were seeing with some of those meme stocks, but the difference obviously is that the fundamental arguments are
right. Well, and it does look, the price action now looks not only similar, it looks even more extreme than the previous two, maybe not the 1981, but the previous two peaks that we've seen in the metals markets, which were then followed by dramatic crashes and then dead money for a decade. So there are a lot of people who are worried that, is this just the third iteration of that?
Yeah. And I'm loath to use the phrase that it's different this time, but there are fundamental reasons why gold has moved this quickly. Mm-hmm. And I think a lot of them obviously are related to what we're seeing coming out of, first off, there are things that are related to the last, decade plus of excesses that we built up, that we have kind of here in the West, blithely ignored. I'm talking about our fiscal situation. And we've kind of just assumed that we could continue to borrow as long as we wanted. And meanwhile, we knew that our foreign creditors were starting to diversify away from dollars. And yet no one was hitting the alarm bells because it just seemed like it was so glacial and none of it was really going to add up to anything material. And frankly, as many times as people like me and you were warning that this is eventually going to reach a point where there's going to be a come to Jesus moment, it never seemed to happen. So, the deficits kept getting bigger and bigger and foreigners kept diversifying more and more away, and it never had any impact. And now I think those trends have hit warp speed. So they've gone from sort of glacial moves in the background into overdrive. And that's in part, started, of course, with the weaponization of reserves, weaponization of the dollar when we froze reserves after the invasion of the Ukraine. But also, when Trump came in and started this tariff diplomacy and basically using that as a tool for not just, I know the purported goal is to, right our trade imbalance, but it appears like it's much more about moves on the geopolitical chessboard and national security specifically. And then you see this action in Venezuela, and you've got to assume that any of the BRICS countries who now see the US come in and they're sitting on top of the oil reserves and the gold reserves, are saying, we felt like we needed to get our money, shift out of paper fiat currencies into hard assets before this, but now we really got to, we got to hurry it up.
Yeah. And, so I talked to Andy Schechtman a lot. He's the CEO of Miles Franklin, and it's Thoughtful Money's endorsed precious metals solutions provider. And Andy is in the trenches. He's out there buying and selling, wholesale and then retail. So, what I love talking to him about is he's really got a good insider sense on what's happening, in the plumbing of the system. And this really does seem to be a story of shortage of supply, of physical supply. And, there's lots of things you can do to monkey with financial assets, but you can't really monkey with ounces much, right?
Yeah, you can rehypothecate paper gold as much as you want, but when someone actually demands delivery, you actually have to have the bars or coins or whatever it is to deliver. And it's interesting because this, I know we'll get to it in a little bit, but it gets back to the outlook for GDP, because everyone's now touting this 5% plus GDP number in the fourth quarter that we're going to get. But a huge part of that is gold exports.
Right.
And so, we can go through the numbers, but it's not a reflection of strength in the economy. Quite the contrary, it's a reflection of the crumbling confidence in the dollar and fiat money in general, in that people aren't even content to hold gold virtually. They actually want to physically have it. And so I think part of that, again, goes back to the administration's push, which obviously I happen to support. I think it's a noble endeavor to try to, this peace through strength. And, we don't want these crazy dictators running country. We certainly don't want China with its Belt and Road to come in and really be determining what's going on in South America in our hemisphere,
right,
or Greenland, for example. So, I understand all of that. I just think that the unintended consequence of those policies has been to accelerate the diversification out of the dollar into hard assets. And frankly, there's no indication why that should change. It's not like the administration is suddenly going to say, oh, okay, we're going to abandon our efforts on this front, nor necessarily should they, but we'll have to, pay the price in terms of this weaker dollar. And frankly, I'm not sure that that's anything that the administration is really that negative on. I think Trump has generally.
Well, because it helps with trade. Yeah.
Yes. Yeah.
Yeah. Okay. So, look, Steph, we could spend the whole time just talking about the precious metals. We got a ton of other topics I'd love to try to get to in the time we have here, but let's get to the key questions on the precious metals here. So I don't even know. I've lost track. Silver's up, what, 140% or something like that?
It's 25 at the beginning of last year, wasn't it? Yeah. Somewhere around, it was under 30. So it's almost tripled.
So yeah, is that over a double? I don't know. It's crazy. And gold is, like I said, it's at all-time highs too. I mean, so the tractor beam to $100 silver, I think, is pretty locked in at this point. No guarantees we'll get there, but the closer we get to 100, the more everybody wants to pull it there. At 46 something hundred, 5,000 gold is starting to pull its tractor beam too to that price. So there very well could still be some momentum here, particularly because we've got the pull of those large rod numbers, which aren't that far away anymore. But given how far it's all come this fast, do you have a formula at which you're like, okay, the gains have been too good in so short of a time, I need to take some gains here. And if you do have a plan to sell or a strategy for selling, what do you put it into? Especially if you've got concerns about the fiat currency purchasing power and all that stuff.
Yeah, I think unless or until there's some policy shift that is going to somehow shore up support for the dollar. And not just here in the US, but a similar implementation of policies in the G7, it's hard to argue that gold is going to go lower. It just seems like maybe it's not going to keep going up at this rate. And I would be very surprised if it did keep going up at this rate. Mm-hmm. But the argument for selling strikes me as fairly threadbare right now. And I think one of the things as we come into this year, and we've got the impact of the one big beautiful bill with the change in tax withholdings and the huge 150 billion plus tax refunds that will be coming. Now we've got retail gasoline prices below $3 a gallon, which is, a huge relief to low-end consumers. With the economy, the outlook for growth is obviously stronger, but along with that, the outlook for inflation is also hotter. And then as you see, this shift toward actual hard assets, you're seeing that reflected in commodity prices more broadly, mm-hmm. which again, is the tinder into things like the PPI, which then ultimately feeds through to the CPI. So yeah. I think we're in an environment where just stepping back and looking at the administration's efforts to have more stimulative monetary and fiscal policies, that you should generally assume that inflation is going to tilt hotter than cooler. And that creates this kind of tension between interest rates, and the objectives of the administration, because they obviously are pushing very hard for the Fed to be very accommodative. Mm-hmm. But if growth is strong and inflation is heating back up, what is the case for that? And if they do go ahead and ignore those indicators that inflation is starting to pick back up again, and the Fed cuts rates or, expands its balance sheet anyway, then you're just putting more pressure on the currency as a valve for those sins.
Right.
Which again, inures even more to the benefit of gold. So I guess, right now, when I step back and look at 2026, and it seems very clear for the first 2 weeks of the year that the administration is all in on the midterms and that they are going to.
All right, folks, you're probably seeing Steph freeze.
Sorry,
which is what I'm seeing.
Lose me for a minute there.
She's back. So you froze, but I think you're getting to a point that I was going to talk with you about anyways. You've crammed like 5 subjects I wanted to talk with you about into this past answer, which is awesome. But it sounds like I think you were about to say, it looks like the administration's going to do whatever it can to run the economy as hot as possible up to the midterm elections to try to hold on to Congress.
Yes, absolutely. And so you want to be positioned for, stronger inflation readings, okay. Which obviously would be negative in terms of this issue we've been fighting all along, which is that long rates have refused to come down. And if they didn't come down last year, what's the argument for them coming down against a backdrop of highly stimulative monetary and fiscal policy?
Okay, so I got a whole bunch of questions here for you. Let's just try to bang through them real quick. So what I took away from what you said to the earlier question of what do you sell your gold for, I'm taking from you, hey, until and unless we adopt a very different form of monetary and economic policy, you're not selling your ounces. Miners might be a different story, and we can talk about that in just a little bit. But am I correct in that?
Yeah, absolutely. I mean, I think that, loath as I am to say it, we're on the doorstep of a regime change in terms of the monetary.
Okay. Steph, you froze up there again. If you can hear me, what you might want to do is just hop out of StreamYard and hop back in. Folks, while we're waiting for her to rejoin us here, I'll tell you what I'm going to talk with her about when she gets back in here. So Stephanie, has been there she is. Stephanie has been she's sort of been on team disinflation and deflation for all of the economic concerns that she and I have talked about for many prior appearances on this channel.
Sorry.
No, it's okay. That's okay. But you're back. Okay.
I was trying to check going on with my internet, and I was trying to figure out.
Okay. Yeah, you're still kind of freezing up on us, Steph, here. So folks, hang with us. We'll give Steph a moment or two to keep trying to troubleshoot here. Steph must be on a dial-up modem, says Johnny Blades. But what's interesting, and I talked with Steph a little bit before we hopped on the camera here, is as I've been mentioning, the administration is getting increasingly aggressive in terms of its policy, economic policies. I think to try to, as we were saying there, to run the economy hot leading up to the midterm elections. I think the administration knows that affordability has been weighing hugely on people's minds. It was a big reason why Trump got elected for the second time in the first place. And so, now we've got everything they did last year with the big, beautiful bill and extending the tax cuts and the deregulation and the tariff revenue coming in and the trade deals. The administration, especially Bessent and guys like Lutnick, are saying, hey, that's going to create a bunch of tailwinds for this coming year. We then, as Steph just mentioned, it looks like we are definitely going to have about $150 billion or more worth of stimulus coming from the largest tax refund in history here. Folks are going to go out and spend that. And I've mentioned this on X, I just listened to an interview, which I highly recommend you listen to if you've got the time and interest. It's with Chamath Palihapitiya, one of the guys from the All In podcast, and he interviews Howard Lutnick, the Commerce Secretary, in detail. And they really go through tariffs, and whether you hate them, whether you love them, it's really helpful in understanding kind of the logic behind how the administration thinks about using them, and also just mechanistically how they work. It's really fascinating. You hear Lutnick explain it, and you're like, wow, this really is putting a lot of money in America's pockets, a lot of net money in America's pockets, coming from the rest of the world here, not just a tax on the consumer, but really money coming from outside of our borders into our borders. And then for everything else around that, that I mentioned earlier, Lutnick saying, hey, we're going to start seeing some real tailwinds to the economy in 2026, really starting about now. And he says, look, I think easy, we're at 5% GDP growth for 2026. And I can see instances in which we're at 6% GDP growth. And so, Steph, I was sort of putting words in your mouth, so feel free to massage them in any way. But I think you, like me, are starting to shift your thinking about how bad 2026 could be, at least economically. Let's put the market aside for a second.
Yeah.
But economically, I think the recession odds are lessening because of all this, all these tailwinds to the economy that the administration is forcing onto the economy, if we'll say, and that likely. It's probably not going to be a year the wheels come off the economy. Not going to say never. I'm just saying those odds are dwindling. And so folks like you and I, who were pretty pessimistic about the economy, say a quarter ago, I'm less pessimistic on its performance in 2026. And let me just say one last thing, Steph, and I'll let you respond to all this. Is when Trump came out with the we're gonna buy $200 billion of mortgage-backed securities. I was like, you know what? I hate that. I totally hate it. But I'm like, okay, now I'm convinced the administration's going to do whatever it takes to prop things up. To me, that was a clear sign that they're like, I don't care, whatever we have to do, no matter how odious we think it might be, we're going to just do everything we can to hopefully get the average person to feel a little bit better about their personal finances when they walk into the voting booth in November.
Yeah, absolutely. The problem is, of course, in the details. So, as is always the case, and this is a topic that I've been really, because I came to the same conclusion as you. Is it was pretty clear they're just going to throw everything at the wall on the affordability issue and try to get that midterm vote shored up. But what they're trying to do essentially is to bring up the bottom of the K. This whole K-shaped economy notion. And essentially what they're saying is we're now singularly focused on the bottom of the K. And to bring the bottom of the K up, let's use a couple of examples. Number one, they're talking about capping credit card rates at 10%. Well, as all the big CEOs come out and said, it's not a viable business model for us at 10%. Now, maybe that's an exaggeration. It's probably viable at some number between 10 and 28, which they're currently charging, But the point is, so it'll be a negotiation. But ultimately, there are unintended consequences of the administration coming in. It's the equivalent of wage and price controls coming in and saying, this is the interest rate that you're allowed to charge, at which point the banks will say, okay, well, we're not going to lend to those low quality people.
Yeah, exactly.
Doesn't justify the risk of being exposed to those people. So now, and I was talking to one of my clients who's a financials guy, all he does is financials, over the weekend after that credit card tweet went out about the impact, perversely, on driving people to buy now, pay later options, which are probably even more fraught with risk, because if you can't borrow on a credit card, well, you'll do all these other things and go to, back in the day when payday lenders actually were flush. So now it's replaced by buy now, pay later. But so there are unintended consequences of these things that aren't great in the long run. And then you look at housing, and this is the one that I think is the most important, is it's obviously the key to the affordability issue. And right now, the administration is trying everything to get mortgage rates down. And this idea of having Fannie Freddie buy $200 billion in MBS is great, except that they ramped up their purchases last year. They had been buying all along, behind the curtain, that people weren't paying attention to. So they have already been ramping up their purchases. All that's accomplished this year is that they're going to kind of sustain that pace. And it's just going to offset the QT that the Fed is still doing on MBS in its own book. So it's essentially a wash. I don't see that that's going to materially move the needle on mortgage rates. It didn't move the needle last year. And this year, they're fighting the Federal Reserve balance sheet unless or until that changes, which is another concept that I think will happen down the road. But in the meantime, given the policies as stated now, I don't expect a whole lot of relief on the mortgage rate side to happen. Which means
which is what we don't need. I mean, if we're trying, look, I get politically, you don't want people to feel like their houses are going down in value, right? But at the same time, if the issue is unaffordability, they need lower home prices. That's the answer.
But that's the thing. So that's exactly where I was going is, okay, if the rates aren't going to be the relief, it's got to be the prices. And if it's the prices, then what you're doing is you're taking the top end of the K and saying, you're going to go down so that these guys first-time home buyers can finally afford a home. You're going to take a hit to your net worth by having your housing, which is your number one asset in most people's case, go lower. It also, from a nerdy economist standpoint, is the asset that has the largest wealth effect because it's so important. So it is generally understood that the impact of the wealth effect from housing is 10 times that of stocks. So as much as the administration has this noble goal of improving affordability, the downside of capping or even, cutting out, causing a decline in that real estate net worth for the high end could more than offset the benefit in terms of the whole impact on the economy. Now, you'll get confidence boosted at the low end, but at the expense of the high end. And as we know, awful as it is, the high end is the engine that drives this economy. So, it's a push-pull because they might get more votes at the low end because people start to feel relief, but it will come at the expense of, a very important sort of constituent to them. So, this is the bigger question for me is all this policy making that's so frenetic and is clearly designed to focus on the bottom of the K. And, he said on the campaign trail, and Bessent reiterated it, Wall Street's had their day. It's Main Street's turn. And Wall Street ignored that message and just was like, yeah, whatever, it'll be fine for us. Now, this is the risk for the economy this year. It's not from a macroeconomic standpoint. It's that the equity market begins to fall apart. And that's the risk to the economy, is that this increase in volatility associated with staying up on Saturday nights to read Truth Social tweets and try to figure out what it means for your trades on Monday, begins to unnerve and rattle investors. And we see a risk-off move. And that would be the thing that would pull the rug out from the economy. That's the concern I have now.
Okay, that's a great point. A couple of things. First off, not surprised that Wall Street has shrugged it off, right? Because, stocks are pretty much near all-time highs right now, right? Whatever. You say whatever you want, my assets keep going up and you're fighting to bring rates down. Like you're doing everything that asset owners love, right? So they haven't really felt any pain yet. And one thing I've been saying recently, and I mentioned it earlier, that while I'm becoming more optimistic that the economy will have a better year than I initially thought, that doesn't mean the markets are going to have a better year. And I think for so long, they've been so tightly correlated that everybody just thinks of the same thing. And as you and I have talked about, Stephanie, over time, the market got so big, it really became the tail that wagged the dog, right? So everybody now thinks, well, the market dictates what's going to go on. This year, I'm not saying it's going to be, but I see an increasing probability or possibility that we could have an economy that does this while we have a market that does that, right?
Yeah.
Yeah.
No, I think the only concern about that, again, is the impact on the high end, and numerically, just mathematically, if they pull back from spending, the impact that would have. There's also if they actually do impose things like, say, for example, a 10% cap on credit cards, there is a profit impact there for banks. So their profits will go from absurdly large to modestly large, but that has an impact that ripples through the economy as well. And obviously, if we do start imposing caps on different rates they can charge, you're basically cutting off the credit lever that also is a key driver of growth for the economy. So I guess my point is just there are a ton of risks out there, and the markets, as ever, until just recently, seem to be priced for zero risks and everything just being smooth sailing. And none of the narrative strung together. The economy was going to be strong, but the Fed was going to cut rates 100 basis points. And, everything was going to be great. And I don't know, profits were going to be double digits and stocks were going to grow to the moon. But the Fed had to ease for no apparent reason.
Actually, we haven't even talked yet about the investigation of Powell. If we have time, we'll get there. But let me pull on a couple of things that you mentioned here. So you seem to think that that the impact of the policies that the administration is aggressively pursuing here may likely be inflationary, right? And you already explained why. Let me ask you this. So I get the argument, but I look at two really key components into inflation, at least as measured by CPI, right? And one is housing, right? And you don't expect the mortgage-backed securities purchasing to really make that much of a difference. And housing is disinflating and deflating, depending on what market you're in. Right. And it's 40% of the calculation for CPI. So I think there's a mathematical bias to disinflation in 2026, just all things being equal. Right. And with a 40% share of the calculation, where housing goes, kind of where CPI goes for the most part. Then we also have oil. And I want to ask you some questions about oil in a bit if we have time, but oil prices are low. And there's a lot of things that are happening that could keep oil prices lower, right? I mean, the whole Venezuela thing, if we happen to have peace in the Ukraine at some point this year, whatever. But there are things that keep that energy input cost low. right? You mentioned consumers love low gas prices, but you also love the oil goes into everything. So when oil price is low, that has a deflationary effect and other things. So I guess my point is could housing and oil, what's happening there, could that offset any inflationary impact of what the administration's doing? So I don't know, maybe we don't have rising inflation, maybe we don't have falling inflation, but we just kind of hang out here because they're counterbalancing each other.
Yeah, well, I mean, that would obviously be the hope. I guess I agree with you on the housing side, and I'm a little bit less convinced on the energy side, because I just think that commodity prices in general and energy in particular is going to be an area that people are going to start to get aggressive on. People are going to realize, for example, AI that you and I have talked about endlessly, relying on all this energy, and promising as things like Venezuela are, and potential end for this Russia-Ukraine situation, and who knows what happens in Iran. That could be another very positive development. That first off, in Venezuela, it's going to be years, if not a decade, before any of that oil actually can be. It's also a different kind of oil, from what I understand. It involves a lot of heavy refining.
Right, but we like that oil because our refineries can deal with it. But it's something that's going to take years from when we
exactly. It's not like we just flip a switch and all of a sudden oil is flowing from Venezuela. So that would be nice, but that doesn't seem to be the case. So I guess what I kind of go back and forth on is we've got these cyclical forces and secular forces. And the cyclical forces you just outlined very well, that could cause these prices to go lower. But there's the secular demand for resources that is strong and intensifying because of the actions of the administration. I feel like, there's this Cold War for resources, and the curtain has been lifted. We now see that we're in a Cold War for resources. The US has been asleep. So is the Western world, basically, while China has been waging this Cold War for over a decade. They started their Belt and Road Initiative in 2013, and have been securing resources all over the globe, including in our backyard, that the administration has now woken up to and is taking steps to kind of counteract. But that just intensifies this demand to secure those resources. So I don't necessarily see the case for substantially lower prices there. Now, yes, I mean, there will be cyclical ebbs and flows, but secularly, I think commodities are going to be bid. And as we saw this morning with the PPI, those are still feeding through. They're still the thing that's pushing prices higher. Like in the PPI, services wasn't the surprise higher. It was the commodity side. Right. And I expect that that's going to continue. And then the question is the deflation, disinflation in the services sector and things like, rental, homeowners equivalent rent or whatever sufficient to offset that from the standpoint of the headline numbers? But also, is it sufficient to produce a sense of improved affordability among those low-end consumers? And, the jury is out on it now, and we'll see how the year progresses. But I agree with you just broadly that the outlook for growth is better than it was last year. But the idea that we can have stronger growth with a disinflationary backdrop at a time when we're running monetary and fiscal policy hot is one that I just, maybe it'll happen, but it just intuitively is hard for me to square. And the only way I could square it is if you have disinflation or deflation in asset prices that causes that kind of knock-on effect in the economy.
What'll be interesting is, my opinion doesn't have to be yours, but I think the thing that's going to make the biggest impact in folks' decision when they pull the voting lever, or I guess in modern day when you press the voting button, is going to be their confidence about their job or their ability to get another job. And, as you and I have been talking about forever, Steph, the job market has been weaker than reported. I mean, it's hanging in there. And again, I think the unemployment rate just went down in the last last jobs report we just got. But companies aren't hiring.
Yeah.
Right. And the quits rate's really low, which is a sign that the employee is scared. Right. Now, Trump just did a address last night from a factory floor, up in Detroit. If we can get enough of these jobs, the data center jobs, more manufacturing coming back, stuff like that. Whereas even if someone's not feeling better yet, but they're not feeling worse, but they just feel more confident that, my buddies are getting jobs. If I threw my hat in the ring, I could probably get a new one. That'll probably make a big difference. The question is can we get to that point in the economy if we have a big correction in the stock market where companies are all of a sudden, being forced to make tough decisions? So I don't know. I mean, to the title of this live stream here, I think it's going to be a wild ride this year. I think it's just going to be a year of massive cross currents.
I totally agree. And that's the thing, like volatility is very cheap right now. So, I mean, that seems like the obvious conclusion is to just get long volatility because it's going to be choppy. And I mean, we've seen that so far in the first couple of weeks of the year. And again, we're really kind of just sitting here watching this policy scattershot coming with all new ideas every minute for ways to shore up this affordability argument. So I think the point is like nothing is off the table when it comes to policy right now. Right. And what
maybe everybody gets their own 5 acres in Greenland.
It could be. Oh my God. But what I wonder is if we get to a point where, and you started to see it after this credit card cap announcement on Friday, coming on Monday, and the market immediately is like, whoa, we don't like this. If there's a point where Trump, having been so tied to the market, he constantly points to the stock market as a reflection of his success. If there's a point at which he is chastened by a decline in the markets to kind of back away from certain policies, or whether he actually says, I'm going to sacrifice that top end of the K so that I can bring that affordability home.
Down. Well, here's a question. Okay, leans more Trump than not, right? Leads more Trump than, say,
the bottom of the K.
No, I'm going to say the top of the K.
Oh, okay.
Right? Your asset owners, right? You love things that have assets go up. First term under Trump so far, you've gotten a great ride in your assets. Your taxes, the tax cuts were made permanent, right? If you own a company, deregulation's helping you out, right? So the question is the Democrats, and look, neither of us are political analysts, so folks take this with a massive boulder of salt. But let's say Trump says to them, all right, you know what, it's Main Street's term, and I'm helping mainstream out this year, right? And the market's correct. Are you really going to switch and jump from Republican to Democrat? Are you really going to think that progressive policies are going to be more favorable to you as an asset owner and a business owner? I don't know. I think he might be making that bet, which is like, where are you going to go?
Right. Yeah, it could be. Although, I wonder how much, when you look at these people who are protesting against him, they seem like, well, I really shouldn't even say what they do. But I mean, these are people who probably aren't on welfare. These seem like people, women who went to Wellesley, basically. I'm going to just
although they're not on welfare, but a lot of them are older, and so they, they're Social Security dependent, right? I mean, they're pro government. And look, I'm painting with a massive brush here, folks. So apologize for the stereotypes and whatnot, but they may be on a form of government support.
Yeah, definitely older. So that,
I guess if they went to Wellesley, they're probably doing okay. But
yeah, I don't know. I mean, I don't want to underestimate the willingness of the voting public to vote for things that are not ultimately in their best interests. And I say that as a former New Yorker who just watched the city vote for a socialist.
Yeah.
So, and that is the financial capital of the world. So,
I mean, the irony there is unbelievable.
right.
You know, the first American city to go socialist, New York would have been at the bottom of my list of predictions. Yeah.
Yeah. So I'm loath to underestimate the stupidity of the average.
Well, let me ask you this. This is kind of really the question I meant to ask is, I have felt going into this year, the default is that the administration is going to lose Congress. You'll probably lose the House, might keep the Senate, right? But it's the odds aren't good. They're just not good historically.
Right.
And the bottom half, 80% plus on the bottom half of the K, not feeling very happy. So I guess my question to you is given this kind of aggressive tornado of let's do whatever it takes, do you think that is improving the odds? I mean, do you think that the administration could actually hold on to the House given all of this, or is this likely, to your point, maybe to backfire on them because it's going to create unintended consequences, like more inflation or other things?
I obviously worry about the unintended consequences, but I think in terms of messaging, it's clear that they are now messaging, the Republicans are messaging, and the administration is messaging on this affordability issue. So at least they're in the game, which they weren't last year. So
right, which I think we've talked about this. I think it was a huge messaging mistake. That's all I would have talked about in 2025.
Yes, yeah, I wouldn't have let Biden's. Obviously, this all unfolded under Biden's term, and now a lot of people from his former administration are kind of pushing this argument about affordability being a problem, and the irony appears to be lost on pretty much everybody, except maybe you and I. I don't know, but anyway, no.
Public has short memories.
Yeah. To the extent they're in the game, yes, it definitely improves the possibility, but I definitely worry about the unintended consequences of some of the policies. But, they're out there messaging it, and we'll see. I wish I had, more brilliant insights on the prospects. But I do really worry about the increase in volatility around these policies that are clearly going to run the economy hot between now and October, and how the markets might react to that. And we have to bear in mind that, we aren't just talking about a stock market sitting at record highs and, junk spreads that are tighter than ever. We're talking about financial markets that are levered like never before. So it only takes one little toe stub by some errant, creditor somewhere to set the whole thing off. And that worries me. And then that brings me to sort of an esoteric, far-flung topic, and that is Japan. We've been talking about Japan and how their rates are backing up, and they're now at the highest levels in decades.
Yep.
And so the Bank of Japan is now, they've been spent since 1990 trying to defeat deflation, and now they're trying to cool runaway, what they conceive as runaway, God, I can't even speak today, runaway inflation, and they're raising rates to do so. And the irony is that they're raising rates, but the currency is getting weaker and weaker and weaker. And because Japan is hugely reliant on imports, it's fanning inflation. Right. So the weaker the currency gets, the worse the inflation gets, the more they have to raise rates. And yet the raising rates isn't bolstering the currency. So where I'm going with this is that we had that shot across the bow with the yen carry trade when they first started to raise rates to fight inflation. And I think you and I talked about this, we're like, this could be a major problem because we're going to unwind this massive yen carry trade, and nothing ever happened. And I think the reason why nothing ever happened is that the currency offset the interest rate increase. The yen got so weak that you still were borrowing basically free because you were borrowing in a currency that just kept going lower and lower and lower. Yeah. So you're paying some nominal interest rate. It's better than you're paying a little more than zero, but it's being offset by the currency. The risk now is that the yen is right back to the weakest level it was when they last intervened in July of 2024. So we could get a currency, if the Bank of Japan says, these rate hikes aren't working, the Ministry of Finance might come in and start aggressively intervening in the currency markets, and that could, still rock the boat on that carry trade. But there's another side effect of that, and that is that in order to intervene to support the yen, they have to sell dollars. And what's the easiest way to sell dollars is to liquidate treasury holdings.
Treasuries, yeah.
So it's just more argument for pressure on the high end, the long end yield curve.
Yeah. All right. Wild ride. Looks like it's gonna be a wild ride. Okay. So just two things to let folks know about, and this dovetails into my next question for you, Steph. One is we haven't really talked about it much, but what unfolds in Iran could have a really big impact on the world economy, and I think just the world in general. Personally, I've been pretty vocal in just my support for the popular uprising that's going on there. Who knows how that's going to unfold, but I'm certainly wishing the Iranian people well in getting the freedom that they want. So two things on that. One, a lot of dust in the air about Iran, both in terms of just what's unfolding in real time there. A question a lot of people have is, hey, wait a minute, is the US going to get mired in a war with Iran? So folks, you've seen in the past, I've done some interviews with some of the geostrategic analysts at RAIN, which is one of the top geostrategy firms out there. I just did a few recently on what was going on with Venezuela. Before that, I'd done some with an analyst, Ryan Bohl, around what was happening between Israel and Iran when they were fighting with each other. I've got Ryan coming back on tomorrow for a live stream to just answer any and all questions that you, the viewing audience, has about what's going on in Iran. So keep your eyes peeled. That'll be at 11 a.m. Eastern tomorrow, Thursday. And of course, what happens in Iran could impact the oil markets. I talked earlier about some other things that could impact the oil markets. But like you, Stephanie, we've even talked about this, I think, in several of your recent appearances. I think both you and I were getting, kind of interested in the energy space. It had been depressed for so long that some pretty good values were there, certainly just on yield alone. But, we were kind of looking out and saying, look, the world, still runs on oil. And this is a boom bust industry. And at some point, the pendulum will swing back to boom. And maybe this is a good time to start getting in. And I'd made it public that I had started getting into this space. Since I have, which has been past month or two, space has actually done pretty well. And it actually reacted pretty well to the Venezuela news, which a lot of people thought, oh, they're going to get cratered because more oil is coming on the market. No, not true, at least not yet. And folks, I know there's been a ton of interest in learning more about this space. I am in talks with Rick Rule to come on and do a deep dive on just oil and gas. I literally was just emailing with him on this yesterday again. I'm going to try to get that booked as soon as Rick's schedule allows. Hopefully it's going to happen in the next 2 or 3 weeks, but just know that that's coming. But Steph, I joked, 3-4 months ago that, I've got my silver laser eyes on right now on my X profile, and I'm going to take full credit that's what gotten silver. You should. Right? I put them on at 35 when it had that breakthrough.
Wow.
And then, I've kept them on since. But I've increasingly joked about, when I retire the silver laser eyes, I might put oil eyes on there, right? I'm still trying to think through that, but because there are some developments here that are making me try to think through the second and third derivative effects on the oil price. But let me just ask the question to you. Let's say the time comes when you think gold and silver have completed the majority of their run. You think they're going to do at least in this cycle. Sounds like maybe you're not going to sell your physical ounces per se, but let's say your mining stocks. If you feel like, okay, those things have had their run. Yep. You thinking of transitioning those proceeds into oil?
Absolutely.
Or oil and gas?
Energy, yeah. The whole energy, the entire energy complex, I think. Yeah. And the Iran thing is, obviously I'm not a geopolitical strategist or anything like that, but I think that has the potential to be the most important development on the global stage as relates to what the administration is doing. Because if they overthrow the government and we see regime change in Iran, then you have basically cut out from Russia and China this axis that China, Russia, Iran, and Venezuela to some extent. You know, you've already got Venezuela. If you take Iran out, you've really isolated China and Russia, and they're kind of on an island unto themselves.
Right. And maybe with North Korea, but you know, that's a small player.
Right. But I think that could have massive consequences, like positive consequences for the globe and for the US over the long term. But as relates to energy, I mean, again, I think that it's all upside. Even if you overthrow the government there, you know, the oil that's there is the oil that's there. It's just, where is it going to end up going? You know, right now it's going to China. So now it'll flow elsewhere. But, you know, I guess ultimately that doesn't make me bearish on oil is what I'm saying. I mean, I think it's more of a positive in terms of the long-term setup for the US, and probably would give the dollar a bid. But ultimately, you know, I don't know that it materially changes this demand for resources that we're talking about. And, you know, there's just a finite, this is the beauty about hard assets, is there's a finite amount of them. And we've spent the last several decades basically manufacturing paper. And now we're discovering that there's a massive imbalance between the amount of paper claims we've printed versus the hard assets upon which the delivery of all of that good stuff depends ultimately.
It's the difference between bits and atoms, right? You can create as many bits as you want, but there's a finite number of atoms in the world.
Oh, I thought you were talking about atoms, like.
Yeah, I know. That's why I had to clarify. Okay, so you know we'll continue on this theme of energy in your future appearances, Stephanie, and I'll hopefully have something more intelligent to say about it once Rich come on and I've learned from him.
You have a lot more intelligent to say about it than I do. I mean, it's hard because there's so many cross currents and things are moving a lot, and there's a lot up in the air geopolitically and economically as we turn the page here to 2026. But it's going to be an interesting year for sure.
All right. So on that, you know, if I'm remembering correctly, your portfolio, which you've been kindly transparent about, has been largely made up of precious metals plays and T-bills. And I think maybe you were starting to nibble on energy?
Yep. Yeah.
Okay. Has any of that changed, or is that still your current position given the world as it is right now?
No, I mean, I just have less cash and more energy exposure than I had before because that's how I deployed some of the cash, you know, as the Fed started cutting rates. So
are you dollar cost averaging that, or has it just been in discrete chunks?
No, I mean, it's just whenever I'm like, oh, you know what, now's a great time to start putting a little more money to work there. So, you know, I'm like the typical person, I guess, I'd like to think it's fairly typical in this business, who spends so much time talking to other people about the markets that I don't really focus on my own portfolio very much. I sort of set it and forget it. And I've also had a very long-term view. So it's not like I've been positioning gold as a 3-month or 6-month trade. I've had that position on for a long time. So I don't, you know, do a lot of trading in my account, and it comes in lumps. Let's put it that way.
Well, Stephanie, let me just share with you that, you know, I mentioned I put out on X that you were going to be on today. There was a fair amount of posts there just saying, you know what, I got into precious metals 12 months ago because of, you know, what you and Stephanie were saying. And, you know, I just basically a lot of goodwill coming to you. Now, yeah, and I think you deserve 100% of that. I feel a little bit like, you know, maybe that person started watching 12 months ago. So if they'd been watching 5 years ago, they might have felt a little bit like, well, I had to wait a lot for this, right? But no, but you have helped a lot of people in the near term who have been convinced by, you know, your strong championing of the precious metals. A couple other questions that have users asked, and then we'll start wrapping up. One is they just wanted to get your general outlook for the housing market for 2026.
Yeah.
I know you're not a housing analyst, but you think a lot about it. So where do you think it's likely to go?
Well, to the extent that I am highly skeptical about the likelihood that these efforts to lower mortgage rates are actually going to succeed, don't really see much relief on the mortgage rate side. And that does leave me concerned about prices doing the heavy lifting, which, create tremendous opportunities for people like myself who sold and I'm sitting here renting, waiting for prices to come down so I can get a better entry point. But it will come at the expense, again, of those people who are sitting on equity. And it's important to point out, too, that over the last year, we've seen a huge increase in cash out refi. So a lot of people, who were turned off by the prospect of borrowing at 28% rates on their credit cards have been extracting equity from their homes to generate cash. And so that leaves them more vulnerable to any kind of decline in price. Now, I'm not predicting, a 2005-6, type of bursting of a housing bubble situation, but I do think that prices are more likely to go down than up. And one thing that another myth I'd like to dispel is this myth that there is a shortage of housing supply. There's no shortage of housing supply. There is a shortage of housing supply at the price that people are willing to list it for right now. So you see this really clearly in the bifurcation between new and existing homes, where new home sales, if you think about a builder developing a whole project, he's going to be much more flexible in terms of prices that he's going to offer or rates. Right. Than someone who's sitting in a home who has a 3.5% or 4% mortgage, who's reluctant to sell and then have to turn around and buy a home at 6 or 6.5. Right. So you see the new home prices have come down and are now, for the first time, I think, in history, lower than existing home prices. Yeah. So it tells you a lot about the dynamics.
Yeah. And that's, I think that lower price, I think that's still sticker, right? In other words, like when you factor in all the mortgage buy downs and the benage that they throw in on top of that, to your point, the new home market is showing us where it all needs to go, which is the price just needs to be lower, right?
Exactly. Yeah. And what you also have in the background is this massive inventory that's about to come on the market of homes that are in some stage of construction. And I'm sitting here talking to you, looking out at a massive building that's going up here in West Palm Beach, right next to one that was just completed, between another one that was just completed.
Right. But you live in a strange place, right? Because I mean, you live in one of the few places that's still red hot, and that's because everybody who's leaving the New Yorks and Chicagos and Californias of the world are moving to your town. So yes, but that's true. There still is in a bunch of other. I mean, what's interesting about where you live in Florida is it is totally a tale of two worlds, right? You've got some places like where you live that are still doing great, but you got a lot of places in your state that have had a 2008 style correction.
Yeah. Well, and then you have these older buildings, and it's interesting. This is a really interesting strip that I'm looking at out the window here. There's an older building where everyone's probably in their 70s and has owned their units forever, and they're facing assessments to upgrade the building, and a lot of people can't afford to pay those assessments, so that's a real problem. And it's wedged between two buildings where, the starting condo is $5-6 million on the ground floor, and the penthouse is $40 million. It's insane. So, but it is a tale of two worlds there. But ultimately, I think that there's a huge amount of supply. If you look at the housing that's under construction or completed, and you add in, starts, it's as high as it was during the housing bubble. That's the only time it's ever been this high. Wow. So a huge shadow inventory that as it starts to hit the market is going to depress prices. So I just want to eradicate the myth that there's a shortage of supply. There's no shortage of housing supply at all. And I think we're going to find that out soon.
So I've ranted about this as well, Steph. I agree with everything you've said. The other thing I would add to it is, what I often say is, I don't think we have a shortage of housing units in this country. We have a very stark imbalance of who owns them.
Uh-huh.
A lot of them are investor owned. And the investors had a great time for a long time, especially during COVID, right? But now we're at a point where a lot of those guys are, they're now, those properties are cash flowing negative. And presumably, the longer that lasts, that inventory is going to keep coming out of the market as well. So I'm sensitive, and I agree that, look, in some areas, yeah, we do need to build more. We need to,
right.
try to get rid of some of the red tape. But I think if we just said, hey, look, do we really want to have, I think it's something like a third of single family homes are owned by an investor, whether it's a mom and pop, and it's mostly mom and pops, but increasingly over the recent years, it's been Airbnbers and institutions as well. I do think, and I always get in trouble for this, but I do think we should have a national conversation to say, does it serve us to have investors owning that much of the single family home fleet, homes that are really supposed to be shelter for families.
Right.
And we just saw Trump, put out the trial balloon of, hey, I'm now declaring that institutions can't buy anymore. It wouldn't surprise me over time if we started to see more and more restrictions on what investors could do there, and that would free up a lot of inventory. Yeah. Right. So anyways.
But at a price, because, if these guys have to liquidate those portfolios at distressed values or whatever, then there are financial consequences to that too.
Sure.
And also, we also have to look back to when they started buying, and they created a market that, they stepped up into a vacuum. So we loved them when they came in and started buying up properties, but now they own too many. So it's very hard to have both sides of the argument. And I get it. I don't love the idea that they own a third basically of single family homes. I think that's, creates obviously a problem. But we're in this, we should have anticipated what the implications would be before they came in.
Absolutely. That's the problem with letting the camel into the tent, right?
Yeah. Exactly.
It seems great at the start, and then you have, and now it's like, well, we're going to crater the market if we get it. We never should have let you in, right?
Exactly.
Again, different rant for a different day. All right. Okay, we're gonna end on probably something even a little darker, and I apologize for that. This is the tweet. Literally starts with, "This is dark, but does Stephanie envision social instability arriving in our country, and what could be the catalyst? Does she prep for any type of social instability or fourth turning type of crescendo?" Yeah, it's a dark question for such a pretty person, but just wondering.
Yeah. I mean, it's scary, because I was actually thinking this thought yesterday as I watched the news reports of, what's going on in Minneapolis or all over Minnesota. And it does seem like
oh gosh, Steph, you froze up right when you got to the super interesting part there. All right, folks, hopefully she's going to rejoin.
Am I back?
Are you back? Okay, sorry. You froze right at the start of your answer there.
Okay, yeah. Did I get to the part of watching the news stories out of Minnesota and how, these...
That's right where we lost you.
Okay.
Minnesota.
It's hard not to feel, watching that, like there's an effort being made by some groups to foment instability, and that, they're really... It just feels like there is an effort to, I mean, I hate to be dark like that, to try to create some social unrest there and blow this into a bigger, it already has reminiscences of George Floyd. And if it became a larger nationwide situation, these things can devolve pretty quickly. So it's not a question that I haven't contemplated and I don't worry about. I don't really know how to prepare other than what I have, which is a Glock and my gold and my bulldog. So frankly,
so golden lead basically is what.
But I actually heard someone on some news story today talking about how they felt. I think it was they were replaying a comment by one of the what do they call the AOC and her gaggle of women? What are they
squad.
called? The squad. Thank you. God, I literally am out of it today. So they quoted one of them saying that essentially, oh my God, I'm totally losing this comment, but yeah, I'm sorry, Adam. I'm just so down the rabbit hole.
To the spirit of the question, I mean, do you? How much of your mind share, if any, is spent thinking that like, okay, this could go just beyond my concerns about the economy or the financial markets into real social instability that, I, Stephanie, might need to worry about stepping, out of my house into the street one day?
Yeah, well, I guess that's why I moved to Florida from Manhattan. So I wouldn't have to worry about that as much because it really, I mean, even during COVID, that was a consideration. And now I'd be very uncomfortable being around there. But I feel like, I'm not someone who necessarily lives my life looking over my shoulder, and maybe that's not a good thing, but I try not to expend a lot of mental energy worrying about things that I can't do anything about. But, I don't want to be cavalier about it because it's a risk and it is a function in large part of how long and how persistent this bifurcation between the high end and the low end has been allowed to continue. And, it would be great if we could rectify that problem without having to have any kind of social consequences and have the consequences be purely economic and financial. But I think that's a little bit of a pipe dream because, it could involve pain that ultimately manifests in some social unrest. So I guess this is kind of a long-winded way of saying I don't rule the risk out. I try not to really expend a lot of time and energy contemplating it, but I'm definitely mindful that it could happen. And as I watch what's happening in Minnesota, I definitely am keeping an eye on any potential echoes elsewhere in the country. I'd be interested in what you say to that question, Adam, because you've been on this topic for a long time.
Well, for folks that know, the previous companies that I was involved with, I spent the better part of a decade kind of focusing on this type of stuff. The short answer for me, it's all about resilience, and just not to make this a super long answer. If folks are familiar with the book that I co-authored called Prosper, it goes into kind of how to build resilience in your life. And the shorthand of that is these are steps that you can take in your life across all facets of your life that if we go full fourth turning and there's Lord of the Flies out there in the world and supply chains break down, all that stuff, you will be less vulnerable to those forces. But if the world just keeps chugging along, these are things that are still additive to your quality of life, right? You're not going to look back and regret that, my goodness, why did I invest more in my health? Why did I learn more skills that are practical? Why did I build community and have tighter social bonds, right? These are things that are just good no matter what type of times you live in. So from my perspective, it's just, I live my life according to that framework. So yeah, short answer is cultivate resilience. It only has good benefits for you. All right, well, look, in wrapping up, Stephanie, thank you again. These are wonderful, and it's so great to see you. I will say though, real quick on the resilience side of things, one of the things that you are doing well, Stephanie, by helping so many people is you're building your own form of social capital, where there are a bunch of people who are deservedly fans of yours because you've legitimately helped them out. And so, if you were to ever to fall on tough times and need to get out of your place there in Florida, I'm sure there's a lot of safe places for you to land. And of course, my house in Reno is one of them. You come hang out with Ashley in the great free state of Nevada if you ever need to. But that is one important investment that you're making with your time here, whether you are aware of it or not. All right, and wrapping up, Steph, just again, give folks a quick reminder of where they can go learn more about your upcoming conference on February 17th and
18th. Absolutely. I'll pin it on my Twitter feed, but at S.Pomboy on Twitter. And you can register. I'll put the link there to register. It's only a month away, so we're only have a few tickets left, but there are options to do a VIP, extended VIP thing. The conference is on the 17th. We have a VIP day on the 18th, which will include some real quality FaceTime with the likes of the two of us and a bunch of other interesting people, and a boat excursion, and it's going to be great. So I'll post that on my Twitter. And then for people who want to learn about Macro Mavens, they can go to my website, macromavens.com, and learn how to subscribe and all that jazz. And I promise next time I'll have better internet, and my brain will also be functioning so that the words that are in my brain actually come out of my mouth.
No, I know it's hard to be on when you're worried about your internet connection and stuff like that. So don't worry about it. All right, and folks, yes, macromavens.com. If you want to follow Stephanie in between her monthly appearances here, well, then just go and subscribe to her work there at Macro Mavens. All right, well, in wrapping up real quick here, folks, if you want to get some professional help from a professional advisor who takes into account all the macro issues that Stephanie and I have talked about here, in hopefully figuring out how best to navigate your financial wealth through what looks like it's going to be a pretty wild year ahead. Obviously, you can go fill out the short form at thoughtfulmoney.com there and talk to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. It only takes you a couple seconds to fill out the form there. The consultations you'll have are completely free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. Lastly, I just want to remind folks that the special offer that Andy Scheckman and his team at Miles Franklin have created exclusively for the Thoughtful Money audience to buy junk silver. Now I think it's at $1.35 over spot. Still one of the best deals that Andy's seen in his 30+ year career. Supplies are still lasting. So if you want to take advantage of that, go to thoughtfulmoney.com/buygold. And Andy and his team will be in touch with you right away after you fill out that form, either to help you take advantage of the junk silver offer or just to answer any other, precious metals purchasing, selling, or storage questions that you may have. Steph, it's always so wonderful. Folks, please do me a favor, hit the like button to show your appreciation for Stephanie, and definitely let her know in the live chat here, if you're watching live, or in the comment section below, if you're watching the replay, how much you enjoy having her here on these monthly sessions with her, so that hopefully she wants to keep doing this with us.
Of course. I'll do this as long as you'll have me.
Well, that's easy, Steph. We'll have you forever. All right. Well, look, I know you got to go, and I've got to hop off to record my next interview in just a couple minutes. But Steph, so great to see you. Thank you. Another great, wonderful discussion as always. Really looking forward to seeing you in a month. I hope as many of the viewers here watching who can join us choose to join us there. But again, just thanks for everything.
Thank you. I guess we'll talk next, just a couple days before that conference. So that'll be great.
All right, and hopefully we can inspire any procrastinators to come join us. All right, Steph, please give Wilhelmina a good scratch behind her ears for me.
And you do the same with your two Bs.
Will do. All right, Steph, thanks so much.
Bye.
And everybody else,